whatever the funds are available that can be properly utilized in a proper way is called financial management. So whatever the profit comes to for investment, entire money will not be utilized. Some about 20 to 25% kept as a reserve. A company might also seek funding from a private equity firm considering selling assets like a real estate. This is important. Hello my dear students, I am Dr. B.S. Subramania, called by Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to hand Financial Management, 4 semester Unit 1, Session 3, Introduction to the Financial Management. This is Unit 1. We are going to have the third session. We are going to have what is financial management, scope of financial management. I already explained what is financial management. Today I am going to explain what is the scope of financial management. Financial management is the operational activity of a business that is responsible for obtaining and effectively utilize the fund necessary for the resources. Whatever the funds are available that can be properly utilized in a proper way is called financial management, because finance plays an important role for the development of the business. Then, scope of financial management. Number 1, investment decision. Financial management involves decisions where to invest the organization fund, where to invest to achieve the highest return and best line with the company's strategy goal. So as a financial management, so they have to involve decision where to invest, when to invest, how much money to invest. This includes evaluating the different investment opportunity and making decision about the capital. Whatever the capital expenditure, how much money you have to put in the asset, means capital expenditure is nothing but purchase of asset. So they must have an idea whether to purchase it or taking the goods on the, what's called, the building, machinery, furniture on the lease. That is called your capital expenditure. So more amount has been involved here. Second one, financing decision. Financial management also deals with to raise the necessary capital to fund investment. So financial management aims to find out the fund for the organization. This includes deciding on the mix of debt and equity. The firm have got once debt and equity. They say that capital employed, equity share capital plus preference share capital plus reserve and debt. We borrow the money. This includes deciding on the mix of debt and equity, financing as well as the specific type of debt and equity instrument to use. Dividend decision. Financial management plays a crucial role to shareholder as dividend. This decision must balance the needs of shareholder with the organization need to retain earning for reinvestment. So whatever the profit comes to for investment, entire money will not be utilized. Some about 20 to 25% kept as a reserve. So this money will be utilized for reinvestment purpose. Every company, they have to do it like this. If you have got 100%, entire 100% will not be, profit will not be utilized. About 75% will be utilized as a dividend. The remaining money will be kept as a reserve for reinvestment. Working capital decision. Another prominent decision that comes under the scope of FM is working capital management. To determine the cash flow, whatever coming in, financial executive first list the company's assets and liability, short-term operational expenses and short-term liability are paid for which through cash flows. Whatever the cash received that can be utilized for the short-term operational expenses and the short-term liability. To manage working, what is working capital? Current asset minus current liability is called working capital. The finance department examine the inventory ratio. They have to find out the stock turnover ratio, the collection ratio, that is debt collection ratio, that is 365 divided by debtor turnover ratio. What is debtor turnover ratio? Credit sale divided by average debtor. What is credit sale? Total sale minus cash sale minus sales return divided by average debtor. What is average debtor? Opening debtor plus closing debtor plus opening BR plus closing BR whole divided by 2. That collection ratio and working capital ratio, sales divided by working capital ratio. They study the finding and professional in conducting the efficient commercial operations. Capital structure and planning. In the scope of FM, the professional must create a plan for structuring the capital after forecasting the finance budget. They must keep the tabs on transaction and divide the available fund into various categories such as owner risk capital, borrowed capital, and long-term and short-term debt equity ratio. Here, the problem is they must first keep the tabs on transaction and divide the available fund, whatever the funds available, into various categories such as owner's risk, borrowed capital, and long-term and short-term debt equity. Debt is to equity they have to look after. Capital structure determine how to pay for operation and growth of interest rate low. Taking on debt might be the best answer. A company might also seek funding from a private equity firm considering selling assets like a real estate. This is important. How to manage the particular fund depends just like a real estate they have to go. So finance manager plays an important role for the development of the business. So I have explained the scope of financial management. Now, functional areas of financial management are decision in financial management. The traditional role of the financial manager was accurate record keeping, preparation of reports on the company status. So here, the part played by the financial manager is very important. It should be accurate record keeping, preparation of reports on the company status, performance and managing cash. That is most important. Performance and managing cash so that the firm could pay its bill on time. So he has to manage in such a way that the bill of the company has to pay on time unless it's a bad mark on the part of the especially company. If you want to maintain the goodwill, no, so that should be paid in time. That's what we are saying now. In this role, the financial managers were called only when their specialty was needed, that is, especially for obtaining additional funds. This is important. Called only when there is a specialty was needed, that is, especially for obtaining the additional funds. Over the years, the role of the financial manager has changed considerably. Here, the role of the financial manager is so much important. He has to manage the amount in such a way that where to put, how much money to put, so that all the bills should be clear up on the due date, so that the goodwill of the firm should be maintained. Business has become larger and more complex, so the financial manager is involved with the total amount of capital. This is the total amount of capital employed by the firm, allocation of funds to different projects. This is important. Business has become larger and more complex, so the financial manager is involved with the total amount of capital employed by the firm. Whatever the money got employed, that can be properly utilized, allocate the funds in such a way for different projects. The company has got different projects. For all the projects, the money should be distributed very carefully. These are all in the hands of the financial manager. So, financial manager plays very, very important role because the entire finance of the business in the hands of the financial manager. He has to play such a way that employed the firm allocates the fund to different projects. Allocates the fund into different projects. It is in the hands of whom? It is in the hands of the financial manager. Determining the financial needs. Financial needs may be different from firm to firm depending on the nature and size of business units. This is what financial needs may be different from firm to firm. So it differ from one firm to another firm depending on the nature and size of the business unit. So the financial needs depends upon the size of the business. Finance is required for preliminary expenses, working capital requirement, purchase long-term asset, expansion, merger, dividend payment. So, how much money we require? That's the most important. How we have to what's called how the dividend will be declared to a shareholder. Total income of the firm. Say total income minus expenditure first. Then first you have to pay to shareholder their capital, their dividend, whatever money left over, that will be divided by number of equity shareholder. There are two types of shareholder in a company. One is equity shareholder, another is preference shareholder. Equity shareholders are permanent shareholder, where preference shareholders are temporary shareholder. When the company liquidate due to some unavoidable reason, so first we have to pay to the outsider. Outsider amount should be paid off. Then once you paid off whatever amount left over among the shareholder, first we have to pay equity shareholder their dividend. If any amount left over, that goes to equity shareholder divided by number of share. Profit available divided by number of equity share. This is dividend payout. Purchase of long-term asset. Long-term asset means building, motor vehicle, machinery, whatever you require. So this is going to remain for a long term. Nothing but more capital expenditure has been involved. So now in the hands of the financial manager, whether to purchase the what's called asset or not to purchase, because no funds are in the hands of financial manager. He has to invest in the different projects. Second one, determining the source of fund. A firm can raise fund by the issue of share. It may be equity share or preference share, debenture, bonds, or it can take a loan and financial estate from the financial institution or from lenders of credit. So, how you get the finance? By issuing the share to the public and debenture or bond, etc. Or it can take loans and financial estate from financial institution or from lenders of credit. Preference shares are entitled to dividend at a fixed rate. You always say like this, 6% preference shares. By chance, if you say like this, preference share means the rate of dividend of preference share is already fixed as a 6%, but the rate of dividend is not fixed for equity shareholder. So dividend for the preference shareholder is already fixed. Once you get the profit, you have to pay how much? 6% dividend at a fixed. Similarly, debentures are also entitled fixed rate of interest. By chance, great 8% debenture. When you borrow the money from one company, we'll borrow the money from another company. What's called prefix. Debenture rate is prefix. So you have to pay how much percentage? 8. It may be 8%, it may be 9%, it may be 10%. So once you take the loan, so the rate of interest is fixed. Debenture also entitled fixed interest. This is important. Here, fixed dividend, fixed interest. Regarding the equity shareholder, there is no fixed. Once you pay all these amount, once you pay the debenture and their interest, preference shareholders' capital, their dividend, whatever the amount left over, that goes to the equity shareholder. So profit divided by number of equity share, that is the per head dividend. Financial analysis. The financial statement. The statement summarize the performance of the business firm for 1 year. So it may be a balance sheet. Statement, financial statement means it is a balance sheet. How much asset we are having, how much liability or at the end of the year, what is the capital left over. But it has to be analyzed interpret it and compare with a performance similar firm in the same line of business activities. Once you prepare the balance sheet, so if you are doing a X company, same type of business, also doing the what's called another area, you have to compare our firm with that firm, whether our firm is getting more profit or a firm is under deficiency, why our firm is not getting so much profit when you compare to the other firm. All these things should be what's called beauty financial manager has to simplify these, perform similar in the same line of business or with the industry wise average to get a clear picture and to take corrective action wherever needed. So financial manager has to take corrective action wherever they are in need of it. Optimum capital structure. Capital structure is framed with the ultimate aim of maximizing the wealth of the shareholder. So here capital structure is framed with the ultimate aim of maximizing the wealth of the shareholder. A firm's capital consists of equity share. So firm has got equity share, preference share and debenture. Equity shareholders are the owners of residue because they have no right to claim dividend and repayment of capital. Repayment of capital does not arise at all when till the company liquidate. Whatever the money that is contributed by the equity shareholder will not be paid back till the company liquidate. So far, especially companies concerned, no company will be liquidated. By chance, if the company liquidate, because if the firm is doing illegal business, automatically it is an order from the court to close down the business. Close down the business is nothing but liquidation. If such circumstances come, first we have to pay to the outsider. Then you have to pay to debenture. And next is amount left over goes to two shareholder. One is preference shareholder, another equity shareholder. Equity shareholders are permanent shareholder, whereas preference shareholders are temporary shareholder. What the law says, no, first you have to pay the preference shareholder. If any amount is left over, that is then only we can preference shareholder their dividend. If any amount is left over, that goes to equity shareholders. See that optimum capital structure, function of the financial. What are the function of the financial? This is determining the financial needs. Whatever the needs we want, we have to determine, think of. Determining the source of funds. What are the source of funds are available? Financial analysis. So you make the what called fund in a different project, in a different way. Think and do it. Optimum capital structure, how much capital is available. Profit planning and control. You must have a plan and control. Cost, volume, profit analysis. So what is the cost? How much cost can be utilized? How to make the profit? Fixed asset management. We have to, what are the fixed assets are? Land, building, machinery, furniture, whether to purchase or go on lease. Project planning and evaluation. You have to make the project plan and evaluate the project, whatever the project you have been made. Capital budgeting, purchase of fixed assets. Working capital management, current asset minus current liabilities. Dividend policy, how you are paying the dividend to shareholder, you have to make the policy. Acquisition and merger, you have to acquire and merger. Last one, corporate taxation. So these are all the functions of financial management. Profit planning and control. Profit is the yardstick for measuring the success of the company. If the company wants to success, so profit is the major goal. It is the surplus over the expense of the firm. Whatever the surplus means, you have got income, you have got expenditure. From the income, expenditure will be deducted. Whatever the difference comes, that is called surplus. You say like this. This is your income side. This is your expenses side. So your income should be more. Income minus incomes minus expenses is equal to surplus. Income should be more and expenses should be less. The difference is called surplus. Here same. Profit is a yardstick for measuring the success of the company. It is a surplus over the expenses of the firm. Sixth one, capital budgeting. Investment in long-term assets are known as capital budgeting decision. So you have to invest for a long time, more than 4 years, 5 years, 6 years, 7 years, 10 years. Capital budgeting, that is on their asset. It is going to remain for a long, long time. It may be 40 years, 30 years, 25 years, like it is going to be remain. These decisions are crucial for the firm because they are investing the full amount here, because huge investment are made in anticipation of future return. We are putting the money in that way, such a way that whatever money you put, we are expecting the more return. Spread over a number of, the profit will be spread over on the number of years. Working capital management. The term working capital refers to capital required for day-to-day operation. It is a long noun. It is for a day-to-day operation. Whatever the capital required, it is called working capital of a business, particularly to complete the operation cycles. Dividend policy. The available profit can be either retained by the firm, it can be retained by the firm, or it can be distributed to shareholder. In India, it is compulsory that dividend must be paid in cash. Here in India, all the dividend should be paid to the shareholder in the form of cash only. What I told about the dividend, total profit of the company minus expenditure, whatever the minus preference share capital, their dividend, whatever the amount left over that goes to equity shareholder, divided by number of shareholder, it is called the dividend. Corporate taxation. Like dividend payment, corporate tax payable on the profit, whatever the profit earned, we have to pay the tax by the company, affect the cash position of the firm. So when you pay the tax, no, your income will be reduced. But inevitable, you have to pay the tax. Hope you understand. I have explained all things in detail. So hope you understand this.